Asian share markets struggled while the dollar looked vulnerable ahead of a reading on U.S. inflation that could hasten or delay the start of global rate cuts. Meanwhile, locally, lender Absa posted a marginal rise in annual profit as a boost from pre-provision growth was offset by higher credit impairments. Credit impairments rose by 13% to 15.5 billion rand as impairments in the secured lending businesses surged, especially in South Africa, which is Absa's largest market by revenue. Speaking of Absa, the high interest rate environment has been a blessing and a curse for local banks. This has been illustrated by Absa's latest annual financial results. For the year ended December 2023, the bank reported revenue up 8% to 104 billion rand, which was largely driven by net interest revenue. But the bank only made a marginal profit, with headline earnings coming in at 20.9 billion, up 1% on the previous year. But due to economic challenges its customers are facing, the bank's credit impairment bill rose by a whopping 13% to 15.5 billion rand. To give us perspective on the fixed income market, we are joined by James Turp, who is from Sanlam Investments. James, thank you so much for your time. Let's have a look at market sentiment ahead of that US CPI report. And also, perhaps while we answer that, what is the market expecting?
Thanks very much for having me, Nastasha. You're quite right to highlight CPI as being the key market mover for the week. It's US year-on-year expected to be flat at 3.1%. So that's a difficult one, right? It'll definitely show you the trend you would think. The one outlier, of course, though, is core inflation that excludes fuel and food, and that is expected to drop from 3.9 to 3.7. So we're going to keep an eye on that. Of course, the market after Friday's employment data is now pricing the first cut from the US in June, 25 basis points, and about 100 basis points for the full year. But that, as you said in your opening, could be changed, could go either way, depending on that really important data on Wednesday.
We'll get to those rate cut expectations, but let's actually talk about the report. When the report comes out, what specific signs are you going to be paying attention to, line items that will give you some kind of indication that inflation is still running hot?
Well, the devil's always in the detail, as you say. It's going to be, is there any evidence of sort of second round effects building in? That's why you look at the core inflation that takes out those big fast moving numbers. So I think the core is probably the one to focus on this week. That is expected to drop, as I say. It is meaningfully high still by their standards, wanting to get that down to around 2%. So that's the one I think to be focused on. There's some other data out as well. Of course, looking at that jobs data that was, mixed actually, that showed higher numbers of total employed, but that the unemployment rate itself had also gone up. So there was some mixed, but seemingly dovish if you digest all of that information. But yeah, this CPI, I think, focus on core this week, Nastasha.
I'm curious. When you look at the market and you listen to various comments, what's more important here? Is it when the Fed cuts or why the Fed is cutting?
I really like that question because, they're both important, to be honest. The timing, of course, is more about confirmation. What we do see is that the Fed is one of the most transparent. So it's very rare for the Fed not to go if a cut or hike is fully priced. It's very rare that you see the Fed surprise the market. They like to communicate with the market clearly. So the timing is important, of course, but I think you're quite right. Once they get going, that's really what the markets want to see. It's one of the most anticipated pivots, if you like. There's been a few false starts over the last year or so where we got ahead of ourselves, and it now certainly feels the language coming out of the Fed chair, Jerome Powell, seeming to say that it's now almost appropriate time to cut rates. The market has been more optimistic pricing a cut as soon as this month, just a few months ago. So that's been pushed out, but it now feels like the language is making the market believe June's going to happen. And once it happens, though, back to your question, the pace from there is also important, the amount of interest rate cuts, and then, of course, where real returns are relative to inflation. So that's why, there's so much to consider. But for the time being, they're going very cautiously towards this. And you can see that in the way the market's pricing it.
What would happen if the market was caught off guard and we didn't see any rate cuts at all this year?
Yeah, that would be quite a surprise for markets. And you would see risk markets not taking that very well. And why would that be? Well, it's the cost of funding, firstly. So US equities that are quite hot at the moment, you would see that reverse. That would affect global equity markets. Also, then you would see US treasuries, US bonds sell off as well. As the expectation of cuts is removed, then, of course, those longer-term bond yields have to compensate investors. So those yields would need to be higher, specifically if you think about the sheer volume of funding the US has to do. So bond markets would sell off too. And then it would be a question of emerging markets that would probably bear the worst of the pain, that being ourselves, being a liquid market. Our currency would not do very well, as higher relative interest rates would mean different inflation differentials going forward. So you'd find investors selling the emerging market currencies such as the rand in favor of dollars as well, just on a relative risk comparison. So that would be a real shock to markets. I don't think the Fed wants that. We've had a Fed prior to COVID who was concerned back then of getting inflation up and wanting to keep interest rates low to get the economy going. So I think the Fed's very aware of that. So I think that would be a rather unusual scenario. Never say never. We've seen so many weird things over the last few years, haven't we?
We certainly have. Unfortunately, James, we have run out of time. I would have loved to have a conversation with you looking at the main challenges for central banks in bringing inflation back to target, but we'll leave that conversation for another day. That is James Terp, who is from Sanlam Investments. And beyond the CPI reports, we are also going to be paying attention to PPI retail sales as well as industrial production data. However, we're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.